Welcome, I am Stuart MacDonald, a member of the advisory board of Beyond Impact, a venture capital firm that is currently raising its second fund to invest in companies that are developing and implementing alternatives to animal protein in nutrition, ingredients, pharma, materials, and other areas. Now, as the only female-founded global VC of its type, it is a real pleasure to introduce Beyond Impact's founder and CEO, Claire Smith. Now, Claire, Beyond Impact is very much at the forefront of a particular meta trend. But before we go into this, can you share with us your background, your experience, and most of all, what is it that motivated you? What moved you to start this activity?
Yes, I'm very happy to explain that to you, Stuart. So I had a very traditional career in finance and investment, starting at investment banks in the mid to late 1980s through to the late 1990s. All those investment banks became UBS at the end. And then going into investment consulting, initially freelancing, but then joining Auburn Partners in 2004, where I stayed for 13 years. And I was one of the senior strategy analysts within the hedge fund team. And that was a very nice career as far as it went. But alongside that, I had very strong personal convictions around the environment, climate, and the use of animals. And as time went on, going into the sort of 2010s, I became more and more concerned about the climate situation, and especially was quite horrified to find out the impact that the use of animals was having on the climate. And so at that point, it became very difficult to ignore. It was something that I wanted to embed in my own investment and in my investment of personal assets, particularly pension funds. And I came to realize that there was really no product out there, either in terms of the listed space, the long-only space, certainly not in the hedge fund space. And in venture capital, there was very little investment going on there as well, despite the fact that the types of companies that could be coming out with alternative products to the use of animals could be quite transformative in terms of shifting consumption. So that was something I decided to focus on. From about 2016, I started to do my own research into the sector and met up with and networked with a few other people who were making primarily philanthropic investments in this area. Some of which, one of which I'm now working with, in fact. That led me to start making investments and to want to actually roll it into a fund that other people could invest into as well. So from about the time that I was leaving Auburn, I'd already researched the space, identified a few companies that I wanted to invest in, and created a small fund structure that other people could invest into. So the motivation was very much to be a catalytic investor in the space, to enable companies to be created, to grow, to encourage other investors to come into the space, invest alongside us, and through that to chip away at the markets, which are huge markets currently for products that are derived from animals, but to replace those products with ones which are animal-free.
Claire, aside from climate considerations, what was driving you to assist in this series of movements away from the use of animals?
Well, what became evident to me, not just the climate, and I read various reports about the percentage of carbon emissions that were coming from animal agriculture. Statistics vary, but some say over 50%, in fact. But in addition to that, through getting involved with various impact investing networks, which were using the SDGs, I also came to realize that there was a negative or a hurdle that was being created in terms of the achievement of many of the SDGs as well. by this use of animals, particularly in areas such as life below water, life on land, fairly obviously in terms of biodiversity. If huge tracts of land are being used for pasture or to grow soybeans for cows to eat in the winter, well then they're clearly not available to nature to live in the wild. So those were other areas. In addition to that, the water utilisation, so the clean water sanitation SDG, that's a very important one as well, in terms of use of clean water, but then the pollution of the waterways due to the agricultural runoff, which is partly from the animals, but also partly from the monoculture and heavily fertilised and pesticided agriculture, which is the main component of animal feed. So I could see that this effect was cutting across a number of different dimensions, and that I won't say that it's necessarily a silver bullet, but it addresses very many areas which are sustainable development goals, which are goals that our society and governments are attempting to achieve, and this is an industry that is really standing in the way of a lot of those goals.
A couple questions arise from this, to my mind, fairly clearly. One is, aside from, as it were, the externalities that you've just been referring to, in pure investment terms, what are the opportunities that are there to invest profitably? Have there been any particular changes since Beyond Impact was established in 2017 in terms of what sectors, what technologies, what applications, what use cases have either been attracting other investors' interest, or a lot of development activity has been involved, or just look interesting? What changes have you seen there? Another question is, in terms of where Beyond Impact's first and second funds have been focused, has there been any kind of shift in terms of the stages at which you invest in different types of company?
Sure, definitely. There's been evolution in the space, and as a VC, we've had to be conscious of that, reflect that, and ideally get ahead of that. What occurred initially in terms of the space was that products needed to be launched on the market and needed to gain acceptance from consumers and from the intermediaries, let's say the distributors, the retailers, food service operators. They needed to realize that there was a new type of product, primarily in the food space up until now, which could be made available to their customers. And of course, over that early period as well, there was a very strong trend towards veganism, which I'm not sure if it's as strong as it was then, because it was starting from a very, very low base. But certainly people were becoming more conscious in their habits, and that only continued through the pandemic as well, because we saw people getting much more conscious of their health and a healthy diet as a means of protecting their immune system, for example. So in the early stages, we were investing in brands alongside ingredients. I had always felt that ingredients were a good place to be for the longer term, but a lot of these ingredients were very technology heavy. They needed to have a certain amount of R&D, prototyping, and then for some of them regulatory approvals were necessary. Not all of them would be acceptable into the market immediately. They were developed. Some would have to be GRAS certified in the US, or they would have to go through novel ingredients or FDA approvals. And so as a function of that, you weren't going to get immediate revenues from those companies. Whereas with the brands, if they were creating product from standard ingredients, sort of normal food products, let's say, then they could get the product into the market and start to sort of create a buzz around the space. So in the early stages, the first fund was active in brands. We haven't invested in new brands without any IP for some years now, because brands do need to have a moat. The IP can provide a moat. If you don't have a moat in terms of a technology moat, you are just competing in terms of marketing expenses against the large multinationals who have huge amounts of resources. So that's why we've shifted away from the brands, because we really don't feel that the smaller brands can compete unless they have a superior product built on a technological advantage. Another thing that has occurred over time with the second fund versus the first fund is that we're investing in scale up. We're investing in Series A and beyond for this second fund. And that's because in the initial stages, companies needed to be created. So when you create a company, you're necessarily investing in the seed stage. You have the opportunity, obviously in the next couple of years or so, after seeding, to continue to invest if you want to. But we're not, with this current fund, investing in complete startups at all. We're expecting the companies to be Series A and have some existing traction in terms of revenues, or to have brought a product through research and development to pilot stage, ideally beyond the point where they have proven an industrial process at smaller scale, and it's at a point where it can actually be commercialized at larger scale. And another evolution, I would say, is that from the very start, when the big food manufacturers and even the meat producers were just not interested at all in the space, couldn't see where they could get involved. Now most of those companies do have products of their own, and sometimes they have displaced some of the startups that had sort of got things going in the space. And that has led us to focus even more in terms of ingredients, because we see that as a far better place to be, because any valuable functional ingredient that dramatically improves the taste or the nutritional profile or the sensory profile or any other type of functionality of these products is going to be interesting to these much larger manufacturers, who are going to then be able to be buying it in decent size, who have the products, the shelf space, the marketing, distribution in order to really make those products work. So we're not so interested in brands, particularly in this area, but in investing in on a B2B basis in the ingredients that can go into these products, and that these very large manufacturers are going to find valuable in terms of improving their products. Bear in mind that this is a space, as compared to meat, dairy, the typical animal products, where the products are in a continuous phase of improvement. And there's been a lot of focus up to now on creating analogues, so creating something that resembles and can take the place of the animal product. But once you've got to that point, there's nothing to stop these products from improving even further and having even greater functionality. So, improving the taste even further, improving the nutritionals even better. So, increasing the level of, say, omega-3, DC, EPA, etc. in products. At a certain point, and especially where things have got to a scale where the products are price competitive, and they're already coming to that point, especially in some of these ingredients, because the animal products have increased in price so much and been very volatile due to issues such as avian flu. It comes to a point where these products are not only superior, but they are also cheaper. Mm-hmm. And at that point, the food manufacturers are frankly being stupid if they're not using them.
Okay. A simple example of this would be substitutes for egg in cake mixes, for example.
Yes.
At the beginning, I mentioned that Beyond Impact's focuses on companies that are developing or implementing alternatives to animal protein in nutrition and ingredients, also pharma and materials. Mm-hmm. Would you care to share any examples of the developments in those two latter areas?
Yes, in terms of the pharma side of things, we've already made an investment in an animal testing alternative, which is the organs on chips. So basically a sort of was very, very small scale, sort of microscopic scale versions of human organs that are behaving in exactly the same way as a human organ is, a lung that is breathing, or a liver that is sort of filtering waste. And those organ chips can be used to test products, so particularly toxicology testing on the liver chips, where a drug or something else that needs to be tested that is a noxious product is going through the liver chip, and they're measuring at what speed the liver cells are dying, which would be then a means of understanding how poisonous it is. Obviously, the idea with those things is that you can pass it through and you can prove that it is a safe product. And as I said, the lung chips, which are breathing, which has applications particularly, and this company was in fact very active in the sort of COVID times in terms of testing various drugs. So there is that example, but there are also some products which are used in the pharmaceutical industry. I mean, one company that we are involved with is creating collagen, and very high purity collagen is used in the pharmaceutical industry. Other products which come from animals, particularly in terms of reproductive drugs, hormones which are coming from animals, some blood products which are coming from animals. We would really like to see them. There's possibly, because of the size of that market in terms of volume, not such as a great environmental impact, but certainly in terms of the animal lives, there's a huge impact, because the animals are basically farmed for these products in quite an unpleasant way. And in the materials side of things, materials in terms of animal-derived materials have often been seen as a byproduct, but actually for some animals, they are only farmed for the materials. Some of the exotic skins, for example, even sheep, largely for the wool, and certainly in terms of the leather market, in terms of cow leather, it does constitute, I believe, something like 10% of the value of a carcass. So it's not. It's a decent, when you consider the margins that animal agriculture is operating under in terms of cattle. If it weren't for that 10%, it would be unprofitable. So that is another area where there are far better substitutes that can be created, and particularly where those substitutes are also using food waste, which is another area that we've been very heavily involved in the last few years. Well, actually, first food waste related investment did date back as far as 2018, but we've made many more in the last few years, where we're using food waste to create these materials or create other food products, and that's has a huge environmental benefit.
Look, you mentioned earlier the way in which during the pandemic there were signs that many people were increasingly conscious of and putting into practice the benefits of changing their diets. You referred to avian flu as well. In terms of the trends that you see that are part of the broader development that's in favour of what Beyond Impact is focused on, do you want to amplify that? I mean, what are the component parts, whether it's the disruption caused by disease or supply chain issues or any of that, or even consumer trends?
Absolutely. There's a significant number of factors that are all kind of playing towards this trend, and really, I mean, apart from the last few years, we're really amplifying it, and things have been a little bit destabilized, I would say, by the last couple of years when the venture capital market has been quite difficult. We saw the interest rate rising, and people were very much more conscious of the sort of cost of living and were being put off by the premium price of some of these products. But I really see that as a temporary effect, because the long-term secular trend is very much towards these alternatives. Why? There's planetary aspects, there's economic aspects, there's social aspects. The planetary aspects are very much around the carbon, the water, the waste, the land use, the effect on biodiversity, and the fact that this is not just a kind of a thing that the bleeding heart liberals are just kind of, talking about. It's something which is now being enshrined, and has been for a little while, but is really now being put into effect in a way that affects companies very, very deliberately, particularly in respect of the carbon emissions and now the biodiversity targets as well that have been put in place end of last year. So once it starts to impact companies directly, in terms of arguably their bottom line, but their reporting now needs to have this information, and this information is being collated, and companies are being scored on that basis, and investors are making decisions in order to avoid or invest in companies based on their sustainability metrics. So that's where the rubber really hits the road, because then the companies, and actually we have a very nice example of one company, Apple, that made a change to its supply chain to remove itself from the leather market, to some extent at our instigation, because we had discussions with the investor relations department a year or so previously, and put the idea forward to them, and they did that because they were able to reduce their carbon footprint significantly. So, and what are they doing? They're still making the same products, but they're making them with these sustainable alternatives. So we're seeing companies doing that. We're seeing governments make policy changes and change subsidies, and also put direct investment into this area, putting it sometimes towards universities, sometimes creating funds that are investing directly in startups, sometimes investing through various financial efforts in funds that are working in this space. And then additionally, from a sort of policy standpoint, also charging farmers, like we're seeing in the Netherlands, for continuing to produce meat. And there's quite a number of countries now in the EU that have put out dietary guidelines. Switzerland was just recently put out dietary guidelines suggesting that people should eat only 1 to 3 portions of meat per week, not per day, which is what most people are eating, but per week. And I think Spain is 0 to 3 as well. So there's a number that have changed, that adapted their guidelines in that respect. So we're seeing this societal change as well. Another impact in terms of societal shifts is people's concerns about the welfare of workers in this area as well. It's extremely dangerous industry. Often very poorly paid workers, and quite a bit of human trafficking is going on, and modern slavery in this area as well, which people obviously are against. And going back to those dietary guidelines, the health of people, governments are very concerned about the cost of their health budget, which is really more of a medicine budget and a surgery budget, but it really does need to be a health budget, and it needs to be about helping people make adaptations in their lifestyles in order that they are less likely to get the chronic diseases that either make the latter years of their life very uncomfortable, or cut short their lifespans.
And they also create increased overheads for the health systems.
Absolutely.
That are maybe in those countries. Yeah. And in a number of these countries, it's true to say that take Germany, take France, the UK, that per capita meat consumption is falling. Same with dairy. Disease. What about that?
Well, in terms of the zoonotic diseases, yes, they're a very real threat. We've had, one pandemic recently, which really to say it disrupted people's lives, it completely put everybody's life on pause for a couple of years in most countries. Thanks to the lockdown, it caused a lot of people to die before their time, and has left a number of people with very unpleasant long COVID effects as well. So I think everybody must be 100% wholeheartedly in agreement that we don't want to suffer another pandemic. The only problem is that these are constantly brewing within factory farms, and as these diseases infect factory farms, mutate, at a certain point the disease moves out of one species into neighboring species, close in the sort of biological genus, but then suddenly it jumps across from a species barrier from birds to mammals, and once it's got into mammals, then it can very easily get into humans, normally or often through the people that are involved in the animal husbandry area. And we have seen that recently. There have been cases of the avian flu moving into humans, in a small number of humans that are involved in the industry, and clearly we don't want that to expand any further. But we have to be dealing with the problem at its root, which is that the animals are kept in far too close confines where the disease can spread.
On a happier note, you've referred to the last couple of years where, in common with a lot of other sectors, earlier stage activity has found it more difficult to attract investment capital, and that's had an effect on development and certainly on returns, and prices are depressed. Does that not, in a sense, create for us an opportunity to take advantage of a third wave of development? You talked about the first wave, which was about the time that Beyond Impact got going in the middle of the last decade, and then the second phase where we're going into later stage, slightly later stage.
Yes, things. I would say certainly since we started, we've just seen enormous cycles go on in the space. From when we first started investing, almost nobody else was investing at all. It was very much a small group of investors with small-ish check sizes that were just getting companies up and running and hoping that they could get other investors involved. It was so far out of the sort of standard venture capital scene, which was, focused on, software, SaaS, gaming technology, all sorts of things like that, really not looking at this food tech area and this specific area of food tech at all. Then I would like to say that the kind of cycle was kind of bookended by two events. One was Beyond Meat listing in, I believe it was June 2019, and then maybe slightly earlier in the year. But then the other end of the bookend was Oatly listing, which was in June 2021, and that actually was kind of the start of the real hype in the space, because as soon as people see monetization, like you would with an IPO, and obviously having seen the incredible sort of short squeeze that occurred in the stock in the initial months after the listing, people get excited, because the one thing that there may be lots of things that put people off venture capital, but the one thing is that you generally have to lock your money up for years and years and years. And with a company listing on the stock market and getting that kind of response, people thought, oh, good, this is great, I can get involved in this area, and these companies will list in a year or two's time, and it'll be a quick buck. That did, as I say, follow through to June 2021 with Oatly, but then after that, it's been a somewhat of a decline, as there was a little bit of a disconnect in terms of the pricing and the rate of growth of the companies. Obviously, anything that's a success attracts competitors, the food manufacturers, which I referred to before, saw that the Beyond Meat product was achieving traction and occupying shelf space that they thought was theirs to occupy, and they decided, and in some ways rightfully, that it was going to be pretty easy to create sort of copycat type products in this area. So now, if you go into some supermarkets, and particularly Ireland, where I've been recently, the products that are in the plant-based meat aisle are from the same manufacturers as if you go around the corner to the regular meat aisle, you see the same brands, because they've been able to develop their own products over this period of time. So in terms of that evolution, we saw the sort of rise of the startups and the hope that they were suddenly going to grab an enormous part of the market. Well, of course, the regular, the traditional food manufacturers were always going to come in and compete, and they had massive marketing muscle, distribution muscle, lots of reserves, and constant cash coming in from their existing operations, whereas the the startups in this space were constantly having to look for additional capital. So that's where things kind of hit a bit of a bumper in 2022, when that capital became much harder to secure.
But this year we're beginning to see, are we not, the first fairly impressively large fundraisers, capital raises?
Yes, I mean, just recently it's been a raise of around 60 million euros, which was the largest raise that has been seen in Europe, and possibly even globally, actually, year to date, and has really come as a sort of a bit of a bolt out of the blue, when a lot of people, a lot of investors certainly, had felt, okay, well, I can comfortably ignore this. There's nothing going on in this area anymore. I can wait, and I'm not missing anything. So I think that will be a bit of a wake-up call for people, that raises are occurring. Certainly in a couple of companies that are in our portfolio did do raises back end of last year, and one completed a raise. They started last year but completed it in the first half of this year. Those were sort of 40 million or so in size, one a US company, one a European company. So it's not as if there's been none, but they've been very few and far between, as opposed to that period 2020 into 2021, when there was just one round after another, and constant PR announcements, press releases about this one or that one, raising over 100 million. There hasn't been one of those for quite some period of time. But we're seeing the first sort of green shoots. I'm somewhat heartened by the rate cut that we saw yesterday, which again I think allows people to see. Yes, exactly. It just changes people's risk appetite and makes them look at the higher risk end of the spectrum, when the interest rates keep coming down. Or start coming down and then continue. I don't think anybody sees the next move in interest rates being back up. It would be a question of then reflection, and then seeing if another interest rate move down can be accommodated without provoking inflation. And I think the whole story with inflation was not demand-led anyway. It was a supply constriction issue. Yeah. So the period of interest rate hikes that we saw certainly tended to flatten inflation, but it wasn't. It's not as if there's a lot of demand out there at the moment. So that's how I see things kind of shaping up. Is that really? And this is why we're very interested in being able to put more capital to work. We have been working so hard in the last couple of years with our portfolio companies to get them through this period of time, because it became ever more evident that raising capital was really not an option. It wasn't going to be easy. The capital was more than likely to only come from the investors that were already on the cap table. We've been working very hard with the other people on the cap table within the companies that we have invested, have very close relationships with them now, and have really kind of been putting our heads together to figure out what could be done. Furthermore, all of the founders have had a real kind of wake-up call in terms of you cannot run a business in the expectation of being able to raise more capital.
They have to tighten everything.
They have to tighten their belts. So we've been working with them in terms of helping them understand what the priorities are, critical path analysis, what is the key thing we need to spend money on, and if we don't achieve that thing, then all of this other stuff that we're doing is purposeless. So let's just focus our attention on that.
Because I know you get quite closely involved in the development of the businesses in which you invest, but overall it strikes me that on the one hand, what I've characterised as the meta trend is very much on Beyond Impact side, and at the same time the turn in the interest rate cycle and the likely return of a greater appetite for risk-on investment, and the return of activity across more sectors in venture capital terms is likely to play in our favour over the next 2-3 years. And in essence, that certainly strikes me as what the secular opportunity is right now for coming into the space, whether it's with Beyond Impact or by some other means. But certainly if anyone who's been watching us wants to find out more, go to the Beyond Impact VC website, and there's a lot of information there, and you can always contact us if you're a suitably qualified professional, accredited or equivalent investor. But in the meantime, Claire, thank you very much. Certainly hope that all of you who've been watching this find this interesting. We're going to do this again from time to time, and thank you very much, and thank you, Claire.
Thank you, Stuart.